Sorry, folks. We had a power blackout here at the office. Literally, a temporary knocked out the power and the internet. So Michael's getting back on here. We'll pick up here. We don't know what happened, but we had a 20-second blackout. So hang on. He'll be right there. Yes, you're right, Roger. Somebody might have blown our fuse. They must have come into our building and literally uh, they were so excited they pulled the fuse here. But it's back on. The power came back up. The internet came back up. So as soon as Michael gets on here, we'll be right there. So hold on 1 second.
Okay. Can everybody hear me? Hello?
Yeah, we're here.
Hello?
Okay, power's back on. Go ahead, Michael. If we can.
Okay, you lost power. Where were we?
You were going over the results of that trade. Had just asked for questions and started moving into the next phase there. So
Okay.
sorry
Um,
about that. The office had a blackout here, and
okay,
getting
so
back
let's
on.
go back. That's all right, I'm warmed up. So this was the Leap trade. We finished the Leap trade and we're on the free money trade. Is that where we're at?
Yeah.
Okay. My apologies to everybody. And I'm going to take an aside to complain about Pepco, our utility. It just was sold. The CEO makes 50% more on average than any utility CEO in the United States. They have the 50% higher dividend, and of the top 50 metropolitan areas in the United States, they have the worst service. We're in Washington, D.C. or around it, and if a tree falls in South Dakota, we lose our power. Okay, there were no questions. Let's go to what is known as the free money trade, and it's not just a sexy term. It's a real term. I want to use the term so you can get your mind around how to do certain things, what is essentially a free asset. The guidelines are it's a variation of that leap call trade that we just completed, and there's two phases to it, and you can stop obviously after phase one. You buy a leap, you sell calls, weeklies or monthlies. I remember the last one we did was October's. Now I'm talking about a stream of weeklies or monthlies, and you do it until your cost basis is zero. Now if you go back here, you'll see in this our cost basis would be reduced by the first sale of a call. It's reduced again by the second sale of a call. Well, imagine a constant stream of these until your cost basis is zero. And then at that point in time, you can, if you want the cash, you go sell the leap. It may be worth what you paid for it, it may be worth more, it may be worth less. Or you can go into the most aggressive thing you can do, which is you now have a zero cost asset. You've paid it off. You own it outright. You have no mortgage on your house. You have no mortgage on that asset. You've invested no more capital. It's all been repatriated. And you can be very aggressive and creative with that asset. This is real, and it's all about leverage, and it also is really something that people who like to focus in on a specific stock over time, it's one way of dealing with that stock and maximizing your cash and income returns, which is, of course, different than maximizing portfolio returns. And how it works is instead of the 15, you would buy the U.S. Steel January 2016 $15 leap. I have it at $9.25. You might have been able. The spread was $8.75 to $9.25. You could probably get it for $9, and it shows how year to year, when you're deep in the money call like that, there's very little extra cost to acquiring it. If you sold a weekly, now today's Thursday. These are prices from today with an average premium of 18 cents. it reduces your cost basis to 0 in 1 year. Now, if you really were doing this every single day and keeping an eye on it, you might be able to sell weeklies earlier in the week, collect more money, and you could actually get your cost basis to 0 if you managed your calls well in a shorter period of time in the year. I mean, this takes management. You may have to roll your calls. This isn't, just a matter of sitting back and watching. This takes active position management. From June of 2015, though, if you follow this model, you now have a free asset. You have amortized the position. If you want to use that, you're in a position where it essentially is none of your capital is in it anymore. This is a psychological point of view. If you remember from the first hour of the boot camp, I spoke about the psychological makeup of an investor and trader is very, very important, cannot be disregarded. It's something we asked you in your questionnaire. And if you can accept, there is a foregone profit risk here, meaning that, but remember, if you're selling calls and you're called out of the leap, and that's what you would, anyway, the point is you can sell it, you can sell a leap for something in the market. If you're called out, you're going to get the $15 and so forth and so on. But this is all about leverage and having an asset that you can trade against to generate income. This is not a gimmick. It's not something that most people practice because it's something you've got to stick with and do for a long time. But it may be for a certain kind of trade. It's a very special trade. And it's really about how to make aggressive use of covered calls on stocks that you like, except you're not using a stock, you're using Leap. And of course it has the same risks as it does with the original Leap trade, which is the stock can go down, you may have to roll the Leap and so forth and so on. But I think you can see where I'm going with this. This is a very elegant way to radically reduce the cost basis of an asset that you can then use to generate income. Now this third section I call the 100% annualized gainer, and it's a real trade. I made it this morning. It's a name you're familiar with from Options Income Blueprint. And the reason I put it in is there are a handful of stocks that in my universe, very good company, very good future, potential appreciation, volatile, lots of liquidity, lots of trading momentum in and out of the stock as opposed to it being a momentum stock that sort of skyrockets and then can crash to earth and is grossly overvalued. There aren't many of these. And when you find them, you have to hit them hard and you have to trade them the way we've been discussing. I have made this the last thing we do in this session and the last thing we do in this program together because it is the perfect example. Imagine everything that we have done besides make a lot of money. If you've done our trades, you've made a lot of money. Besides that, coaching, unlike training, coaching is a pyramid where you start at the bottom with core capabilities and you refine certain skills, and the top of the pyramid is putting all those skills together in one moment. It is a broadcast journalist going live on the air at an event. It is a baseball player at bat with the bases loaded and several things that player can do. You're at the top of a pyramid, and this is a top of the pyramid trade with a simple trade, but pulling everything together. The stock is GT Advanced Technologies. GTAT is the symbol. We trade it in Options Income Blueprint. I made this trade, more than one contract, in my own portfolio this morning, and it's a buy right, but it's with a twist. Extreme returns. It is the maker of sapphire glass for Apple. Apple is prepaid them. It's going to be in the new generation of iPhones, but it's not just a sapphire glass company. They have large contracts to do sensors and all sorts of specialized industrial materials. As sapphire glass is the next generation of even harder scratch-resistant glass used in mobile devices. It missed earnings. The stock took a hit. It added volatility to the stock, which means it added premium to the calls and puts. Management did commit during earnings to its full-year forecast, which is really dependent on their Apple business, which is in good shape. And it's a factory in Arizona, by the way, that's up and running. And this tumult creates great potential performance, great premiums, and lots of volume. And you can see I'm looking at a $16 position. There's where the chart was over the last 6 months, and where we've been, based the last 2 months, we've been trading in and around that 15 to 17, and a half dollar range. So what you would do is you would buy the shares, and you're not going to believe these numbers. You're going to buy the shares for $16.25. I mean, this is if we've done the trade. I don't know what's going to happen tomorrow morning. You sell the June $16 call for 95 cents, and these, as I said, are our numbers. If you're called out, you net 70 cents per share in 2 weeks. We'll do the math. On an absolute basis, Okay, that's 4.31% in 2 weeks, and that's 107% annualized gain. Let me repeat that. That's a 4.3% absolute gain. It's 107% annualized gain if you're called out. And this is the kind of trade you may want to be called out of, or you may want to own the stock and keep rolling it or moving it. Now, what if you're not called out? Well, the rate of return actually increases. Why? Because if you're called out, you bought the shares for 16.20, 25, and you sold it at 16, so you're losing a 25 cents on the stock transaction. That nets out from the 95 cents, and you end up with 70. If that doesn't net out, if you're not called out and the stock goes down, your absolute rate of return is 5.85%. Your annualized rate of return is 146%. And I haven't put this on charts, but if you're not called out, that 95 cents over here, okay, your new cost basis is $15.30, and you can go ahead and sell it again and reduce your cost basis even more. There aren't many stocks like this, but there are some, and you hopefully at the end of a boot camp and hopefully at the end of 6 weeks of what we've been doing together, you will have the confidence and to do a buy right. Oh, I only want to sell puts. A buy right is no different than a put if you're called out. It just there's no difference. You're using capital, and you're using capital for a specific period of time. And when that period of time is over, you have the capital back in your profit. Remember, in a put, you either have to roll it if the stock goes the wrong way, or be put the shares. It's the same risk as if you buy the shares and you're not called out. There's no difference. So the bottom line here is your capital is tied up. You have fantastic potential rates of return. And this is what I would call an aggressive trade. It's a buy right trade. And they're out there. And it would be great for me to know you're using what you learned here, in addition to what you already knew, in addition to potentially any changes in confidence about doing a buy right, in the money buy right. You're selling it in the money call to produce these kinds of returns.
Michael, good question is why is GTAT a good one for this kind of trade? Can you just say that?
I'll go back to where we started. It's a fundamentally sound company with a terrific future. This is not, I didn't start with a chart. I didn't start with a technical screen. I started with the company. If you take a look, let me go to the chart. You can see where the stock was 6 months ago, and when it skyrocketed with the Apple announcement. But the thing is, it's a real company. This is not a social media company that doesn't have a business model. This is not a speculative biotech. This isn't a little Taiwanese circuit supplier getting its first contract with an American company. They have contracts with lots of companies to do other industrial goods and products, and that's why they took a hit when they missed on earnings. They were only a little bit soft. It wasn't a lot, because they have an extant business that analysts know, and they didn't hit their number. I like it. You've been here almost 2 months. Start with the stock, and it's a very, very good company and stock. And because of recent events, this run-up, because of this run-up, the missed earnings announcement, everything that's going on with Apple and the anticipation of the Apple product announcements, it's volatile, which creates premium, and it's very, very liquid. So you have this wonderful mix of a fundamentally sound company with a stock that is undervalued due to headlines, a stock that is trading in a bumpy way, creating volatility after a skyrocket run, with loads. There's over 3,000 or 4,000 contracts in the position that I'm talking about, and it may be three. It's somewhere between 3,000 and 4,000 open contracts. So there's a lot of the positives that we spoke about a zillion years ago on how to pick a stock with an option. That's why I'm saying this trade pulls the whole pyramid together. One of the things I said is when you pick a stock for your bullpen, fundamentally sound company, very good stock with lots of upside catalysts, which will be the shipping of a new iPhone, but you cannot ignore the potential and how the options will behave. And we have loads of liquidity, loads of volume, loads of volatility, and therefore loads of premium.
So Michael, the question is, why couldn't you do this with an Apple or a SanDisk? We've also talked about
you won't get 100%. The title of this is the 100% annualized gainer.
Okay, then that leads to the next one. They want to know what are the other potential 100% gaining stocks potentially?
I'm not being coy. I can't tell you right now.
Can you give one out?
Not one that I have confidence with, but I'm willing to put out an alert in the next day or two if you're willing to do it, Dave.
Yes.
did was I have a let me explain why not. I have a bullpen of 25 stocks, as you know, and I have a prospect list of 50. And on the bullpen list, GTAT, and the prospect list was the first one to come up that this could happen. So I made the trade in my portfolio this morning just because I wanted to say I did it. And so after I found it, because I know these exist, and they're confined to a certain part of my portfolio, and I don't do them very often because I typically, in my own portfolio, trade 5 to 10 very concentrated positions in and out, and GTAT is not one of them. The bottom line was I stopped looking. So I'm not being coy. I'm not trying to give you a hard time. I'm not willing to put my name on something. Now I can give you places to look.
Yeah, that's I think what they're looking for. Just help them.
The places to look would be companies like EOG Resources. Would be
ticker.
Maybe EOG. I don't know. I don't have another computer with me, and I don't want to lose the screen. Well, actually, I'm not going to lose the screen. Let me go look. EOG Resources, which is a huge play on, on the Eagle Rock shale formation in Texas. I'm going to call up the symbol in a minute. On given events, and this will happen around, oh, Jesus, look at it just blew up today. I mean, up, as opposed to blow down. The symbol's EOG, excuse me. Gilead, in a week or two before earnings, or if you go check and see what the dates are for when third-party or Gilead data is typically released on sales, everyone's scrupulously following Sovaldi sales. But I don't know if you're going to get 100%. Yeah, EOG has gone in the last year from 60 to 105, almost in a straight ski slope. They're very, very earnings sensitive. And there are a company that this situation I know has arisen in the past. Before earnings, SanDisk, which you're familiar with, is like this. In the 2 weeks prior to earnings, if you believe in the company and you're willing to do a buy right, you can probably get close to these kinds of returns on SanDisk. Now remember, I'm confining myself to my own bullpen. I'm not wandering outside of companies that I like, and I'm calling up my bullpen stocks right now since you have me on the line here. Open recent. There we go. Let's see. Bullpen June 3. And again, before earnings, you can do this with Cree, but it's only before earnings. It's probably in a 5 to 10 trading day window. You can do it with SanDisk. And let's go through the prospect list. ARM Holdings, ARMH is the symbol. SanDisk, the symbol is SNDK. ARM Holdings before earnings, this is probably appropriate. And remember, but the thing about ARM, and the reason it's not in the bullpen, if for example, there was a miss and SanDisk missed, the stock would retrace maybe $10 off or $15 off of a $100 stock, but would come back. If ARM Holdings missed, it could get cut by 50%, which is the reason it's not a bullpen stock and the reason I'm very hesitant to recommend it. But the symbol is ARMH before earnings. Extremely volatile stock because people, and it's not, it has an extreme PE, but it's had an extreme PE forever. And they make, by the way, almost every electronic device in your house literally has something that they manufacture, a circuit. It used to be, and I haven't looked for a while, Michael Kors, symbol KORS, again before earnings. But since they've gone, we first recommended options they can blueprint in the 60s, it's up to 100 or past it. It may have lost the ability to do this, but you can check its KORS, and I'm looking through the rest of my list. And Gulfport Energy, GPOR, which actually has taken a smack lately and is bouncing back. It's the same situation as EOG. It's a fracking play, except it's in the Marcellus Shale in northern Pennsylvania. Is where it's promised. It's where it's why people are investing in it. It's got a high multiple. Those are the companies, and this is almost always before earnings. When I mean earnings, there's two ways to take a look at this. You could try to do this before earnings on the assumption earnings will be great and you'll be called out of the stock. Another way to do this, which is more problematic because it's less predictive, is you do it after earnings if there's an earnings miss, which is what is going on with GTAT. The stock became even more volatile. It came down to a very reasonable price point, and the price point held, which is around 16. So there are two ways to look at this. You would look at it as these names are something I can trade before, or if they miss, something I can trade after. But from my 75, those are the names that are most likely to be able to produce this kind of a return.
Okay. Another question. Let's see. Henry has a question here. So if you can do the 100% trade, is there any advantage to selling a put first on this stock?
You always will. If you trade a stock in and out, like I do, and you stick with the name, you make more money selling covered calls over time because you're going to grab some of the appreciation of the stock. Because you're selling covered calls, you may not grab all the appreciation of a fast-rising stock, but then again, when the stock turns flat or sideways, you're collecting cash and you're lowering your cost basis. So there are some stocks that go from 80 to 90, but rather than make a 12.5% gain, you'll do 20% because you've been collecting cash and the stock moves sideways for a while. If actually my own positions in Gilead, I've been outperforming the stock in the last 2 or 3 or 5 weeks because I've been trading it and almost all with covered calls. Because I'm getting some of the appreciation when the stock went from 71 to 82, but I'm getting more because I'm going in and out of calls and collecting cash. If you sell a put, the only thing you make money on is the put. So you don't have the advantage of the potential appreciation of the underlying shares. It's not more complicated than that. Now, a buy right on a stock you don't want to own, meaning it's the same thing as a put. I know it sounds silly, but it's not. Let's walk through to answer that question. You buy a put, you put up, let's say for GT, you buy one contract. So you're putting up $1,600 to sell a $16 put. With a covered call, you would buy so it would be $1,625, and you sell it, and 2 weeks later you're called out. Well, you're out of the position in 2 weeks and you've made your money. If in 2 weeks it's like 16 and a nickel or more, the put expires worthless. The same block of capital with a couple of dollar difference has been invested for 2 weeks, producing a return, and the return here would be higher than selling a put. So it's not a matter of, oh my God, I don't want to own shares, I want to stay flexible. A buy right where you're selling an in-the-money call and you are anticipating or hoping that you will be called out is, other than vocabulary and maybe a couple of extra bucks like here, it's the same thing as selling a put. And one of the advantages of doing a buy right, if for whatever reason the stock takes off and you become a believer, you can roll the call forward and pick up more profit. And that doesn't happen too often when you're selling it in the money because it means you want to get in and out. But an in-the-money buy right that you believe because of your belief in the stock you'll be called out is functionally no different than a put.
Very good. So I assume GATAT had a huge amount of volatility. That's what.
Oh yeah, it has a very, very high volatility, and as you know, on long-term positions, I take a look at implied volatility, but in short-term positions, it's not, 5, 10, 20-day position. This is a 10-day trading day position. You're really looking at the amount of volume and where the stock bottoms and tops, and it's in a trading range, a little bit below 16, top over 17. So it's a good sweet spot. That's another caveat, by the way. The stocks that I just read out to you, I think all of them have weeklies, and it's very important that when you're doing this, it's probably it's really better, to do it with a stock that's very, very liquid. And some weeklies are not as liquid as monthlies, so you've got to be careful on how you're doing it. This is a monthly position because of the huge liquidity in the monthly volume, and so make sure you don't want to. You want to do something with liquidity because the liquidity also implies volatility, and there's going to be a lot of premium.
Great. Michael, maybe we can do this. If everybody's interested, if you can type a Y in the chat box, if Michael in the next 5 to 10 days finds another one of these, and you'd be interested in receiving an email on that, just type Y in the chat box. We'll send out one to everyone, but if we get enough of you saying yes, you're interested,
sure, that'd be fun.
Michael, if you do it, I promise to get it out to him right away.
So. I promise to find one, but you'll be following it on your own, I think. And I mean, if I make a recommendation, I will not be following it up with what to do with it.
And here's another good question. I like this one from Terrence. Michael, would buying a long leap and selling weeklies be a good way to play an expensive stock like Apple or Google?
Oh, absolutely. I thank you. Did you, Dave? Did you pay that person to ask that
No,
question?
Terrence came up with that. He just
No, no. It's a great, great way, especially a fine company, because you mentioned two terrific companies. You mentioned two companies that if you're in a leap and there's a market downturn, or the president of Google gets a hangnail, and it goes down, you really don't worry about it. Who's going to worry about Google? And really forget the nonsense over what's been going with Apple. The Apple crash and the end of Apple, as we know it, lasted a year. So when you have really good, impressive companies and names, and GTAT really is a great company, but doesn't fall into the same category as Google and Apple. They're perfect companies to buy a leap, reduce your capital, because this, as I said up here, I don't know how many times I said it, it's all about leverage. I just wanted to find a chart that had that in red. This is all about leverage, and when you do a leap, and you're cutting your capital costs radically, and you're selling weeklies, you're just making more money. Now, the other, I'm not recommending this because I don't use margin, but imagine if you did this on margin. So you margin your leap. I mean, you're getting this multiple bang of an impact. But if you use margin, you're also setting yourself up for potential really big-time hit should something really untoward happen to the market or to the position. I mean, to the individual company. But yes, the way to play a Berkshire be a Ralph Lauren, a Google, a Chipotle, even a Panera. I mean, these all have leaps and Google, and they're very fine companies. They're very, Apple and Google, for example, are not as volatile as Chipotle. Short sellers really are hoping that one day someone like chokes on a bean and Chipotle and the stock will go down $200. But it's a fundamentally sound and very, very, very good company, and it's, the stock's several $100s, and because of the possibility of it coming back down, it's the reason it's not a bullpen stock. But that's another one that you could do this against with weeklies. And one of the advantages of doing weeklies is, this little flow here. Let's go back here. You can see your sort of free money trading here. You're chipping away at your cost basis. But what I did not mention was weeklies also give you great flexibility. If you change your mind and the leap plus what you've generated from the weeklies puts you in profit territory, you just let the weekly expire and then sell the leap, and you're out of the position. With a monthly, you have to hang on a little bit longer. If you've sold a monthly that's a little bit further out, you even have to hang on. So reducing the capital costs of a very good company stock and selling weeklies is a very, very good strategy.
So again, when we're talking about quality companies with high prices, $300, $500.
Yeah, and even lower than that. I mean, when you start going above $100 and it's a quality company, you should start considering doing this.
But again, people who are looking to make a play in Apple or Google, that's a great.
Oh, it's great. And the split occurred June. I mean, I think the split takes place tomorrow for Apple.
For Apple, yeah.
So right. It'll be about It'll be about a $90. It's seven. So it'll be about a $90 stock tomorrow.
Phil has a good question. On a buy right, Michael, when you do have a buy, you have to buy back a call or to roll it, or you roll it on a stock that runs away. Let me do the question again. On a buy right,
yes.
When do you buy back the call, or when do you roll it on a stock that starts to run away, meaning up?
Well, it depends. I mean, if it's in the money buy right, theoretically you don't mind being called out. That's the first answer. The second answer, if it's a buy right and you're hoping not to be called out, the timing really depends upon the relative value of the premiums. And what you want to do is this, and I'll take it slow. Let's say you've sold a June, which expires in 2 weeks, and it's a $40 stock. Let's say it's a $38 stock, $39 stock, and you sold a $40 call, and the stock takes off, which would be the position actually with Whole Foods today. And the stock was pretty strong today, and then retreated back from 40. And you didn't want to be called out. You wanted to hold on to the stock. You would take a look at what did you generate in cash from selling the original call. Let's say it was 50 cents. Let's say it was 50 cents. And to buy it back would cost you 75. Well, you have two ways of approaching it. You want to find a call in the next period, either week or month, whatever you prefer, that is going to either generate more cash, meaning if you have to buy back for 75, you're going to look to sell a call that is going to cost you no more than 75. Or you're going to look for a call that you may put more cash in, but that cash is less than the value of the difference in the two strike prices. I know I'm confusing you, but let me step back. Let's use numbers. You got 50 cents and you sold a $40 call. And the stock is now $40.50 and you don't want to be called out because you think it's going to run. You would say to yourself, if I sell a $41 call and it's going to run, well, that's worth $1 to me because I've sold the 40, now I want to sell the 41. So it's worth $1. I don't want to spend $1 in cash. So you have to do that kind of math, but the basic starting math is you're going to try to break even or do better in cash when you roll as if you were rolling a put. That's the first rule of thumb. If you cannot do that while at the same time going to another strike, the first strike was 40, you want to go to 41, you want to go to 42, then you have to start doing the calculation, how much more money do I make if I'm called out of 41? How much more money do I make if I'm called out of 42? You add that into doing your simple math, and then you may have to spend some of your cash and end up net negative on the transaction between the two calls. You collected 50 cents. You may have to spend 75 to buy the call back, and you may sell a $43 call for 25 cents, and so you'll be net negative 50 cents or something like that, but you think the stock is going to 42, so you end up really ahead because you've made another $2. It's a kind of thing, one of the reasons I'm having trouble explaining it is, or clearly explaining it, it's a moving target. Every stock is different in terms of what the premium is for the calls at the next strike price, and also depends on weeks versus month, but the math itself is pretty easy. You know, if I've collected 50 cents, and to move the position $1, I have to spend another 25 cents. Well, that's a pretty easy thing to do. You know, 25 cents produces $1. So it's an easy math calculation, but don't forget to factor in your own belief on the potential for the stock to go to 40 to 41 or 40 to 42. And when that happens, that's part of your figuring out how much you want to spend to buy it back and what call you will sell going forward.
Great. Thank you. Michael, the yeses have it. Everybody wants to get interested in receiving.
Everybody wants a free trade, huh? Whoa, that's a surprise.
Free money trade the next 10 days or so.
No, I think, Dave, that's a great idea. I really, really think it's a great idea. And I will do my homework. And actually, it may be sooner rather than later because I don't know if you remember from a zillion years ago when you were still getting used to my rapid-fire delivery of speech. Thursdays, Fridays, and the following Monday, 2 weeks before monthlies, are my favorite period of time to trade monthlies. It may be personal, and it may be I'm looking through this through a certain prism of success that I've had in the past, but it seems to me that you get the best combination of premium and exposure to a trading period right around this time, from about Thursday, you know, where there's 11 trading days left in the cycle, to maybe next Monday or Tuesday. So it's very possible I'll put something out not 5 or 10 days from now, but even a little bit shorter than that. And if I do it a little bit shorter, maybe there'll be 2 of them, but no promises. I just want to see what's out there, and I'll start taking a look. Not tomorrow. I'll start taking a look. Well, I'll take a look over the weekend. Great.
Okay. If you want to wrap up and.
Sure. Let's go. I think I have a wrap-up paper. Yeah, it's a wrap. This has been a very positive experience for me. No matter how much I like to make money, and you do, we all have different parts of our personality that get gratification, hopefully, in something other than money. And I've enjoyed myself considerably more than you might imagine. You know, you can imagine there's a lot of work that goes into this, and my publisher's been great. Dave has been great. You've heard my editor, Kim. You've heard my other publisher, John. They've been fabulously supportive of I can be difficult at times. And they've been supportive in that I wanted to do this in a condensed period of time. And the condensed period of time, hopefully, has produced a different subscriber, a different member. So if you want to, I would go back and take a look. You don't have to take them again. Just take a look at the questionnaires we asked you to look at and think about whether you would answer anything differently. Take a look at the trades, whether you did them or not. How much could you have made? How much did you make? If you made the trades, unless you were trading half a contract at a time, this course was the bargain of a lifetime. And that wasn't the purpose of it. It just worked out that way. But aggressive income trading will work out that way. And that was the point of my bringing it up. Aggressive income trading. And, you know, we're past tip of the iceberg, but there's a lot more you can do with what you were taught here. And that's the last point I want to make. I want to encourage you, don't push yourself beyond what you're comfortable with. Look yourself in the metaphorical mirror and go, what am I ready to do tomorrow? And the point is, I'm willing to bet half of the people who took this program were not willing to sell an in-the-money put or even sell an in-the-money call on something they really liked 6 or 8 weeks ago. And I hope some of the successful real-world trades that we've done, as well as what you've learned, will convince you that the whole thing is about income, the whole thing is about managing your own personal preferences and your perception of risk, and more than anything, in the Ready for Tomorrow, is, are you ready to leverage your assets? It's the reason in this survey, in this last session, everything was in red when I used the word leverage. How many of you still have stocks out there that you haven't written calls against? How many of you have put money in mutual funds and ETFs which you really can't make any money from, generating income from covered calls? Well, we all know puts from Options Income Blueprint. You've learned wrinkles here on how to do an in-the-money put to get a whole position going, a covered combo trade, and so forth and so on. That's terrific. But if there's one thing you need to you wake up tomorrow morning going, my God, I have X amount of dollars, and 80% of them are in stocks I hope go up, but they're not generating income. And I really hope that from all of this you have both the confidence and the skills and the tools to go ahead and leverage your assets to generate the most possible income you can. I'm going to see you all in Options Income Blueprint. My mailbox is open for the next 30 days. I'll put out another trade, and you've been a wonderful, wonderful group of people, and I really want to thank you.
And then, Michael, we'll look forward to, thank you everyone else. So look forward to your getting the, if there's a good free money trade comes up, we'll get that out. If I can remind everybody again, if you can help us by filling out the survey if you haven't done so yet for this session, these coaching sessions, really appreciate it. Michael can use that information to help improve the value in the future here. And with that, this will be recorded and will be posted on the website tomorrow morning. You can access this session. Thank you, everyone.